Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Good Friday morning. Welcome to Financial Issues. Today's Friday, June the 21st of 2024. I'm your host, Shana, and we are here live, if you're watching the live show, at 8 a.m. Central, 9 Eastern Time, and our phone lines are open for Rapid Fire Friday. Give us a call, 610-363-1110. Call in with your questions about your financial issues, whether you're a partner and you're following our strategy, or maybe you're brand new to the whole idea of investing. Give us a call and let us help you be a good steward with everything that God has trusted you to manage. Well, if you are a partner, our partner conference call that we had this week is posted on the partner side of the website, financialissues.org. Once you log in as a partner, go to the partner, the conference call tab, and you'll be able to listen to the partner conference call that we had just this Wednesday. It was right at about an hour long, and we talked about some of the recent changes to the structure of the fixed income asset allocation, and then the usual updates on the economy. We talked about some pre-election kind of preparations that we're thinking about and making for the, or not making, for the asset allocation models. So if you're a partner, you'll want to tune in and listen to that as you have time. Our stewardship verse from today comes from Ecclesiastes, chapter 11, verse 2. Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. Seth, what do you think?
It's a really good one, Shana. So this verse can be applied in two ways in terms of financially for the Christian. First, generosity, and second, in investment diversification. So this verse, when it talks about generosity, obviously we should be generous because God commands us to, but also because, and this is in line with the law of reaping and sowing, our generosity will come back to us in some way and we'll end up being blessed because of our generosity. The second reason is because of diversification, that when we divide our portion in 7 or 8, that's actually a reference to being well diversified in your assets. So it's an interesting thing, Shana. Diversification, it's not something we created. This is a biblical concept.
Right.
Yeah.
There's not much wisdom in things that we create on our own apart from God.
That's right.
There never is. You know, all wisdom is found in the scriptures. And so when we're doing things like investing, which is something that we talk about quite a bit here, we want to look to the scriptures for a good foundation, for a good starting point. And you're right, it does give us our basis for diversification. It also gives us our basis for dollar cost averaging when you're building a portfolio. We often talk about dividing your whole investable amount into portions, maybe 6, maybe 7, maybe 8, and then deploying that over a certain amount of time. And that will help because just like the scripture says, you never know what calamity may come upon the earth or what calamity might come upon the market in the short term. So it helps to spread that out, unless the market goes completely sideways for 6 months or for whatever the length of the period that you're going to be deploying your capital, then you'll end up getting some at higher priced positions and some lower price positions, and that'll help ease the volatility over the first year.
Yeah, that's good. That's good, Shannon. It kind of opens up a teachable moment for us on diversification today. So one of my favorite Shana-isms, if I can call it that, if that's a word, is you always say, in real estate, it's about location, location, location. Investing, it's about allocation, allocation, allocation. And so kind of this concept of diversification, asset allocation, what do we need to know about this? What can you tell our listeners about this idea?
Right. So, we're always looking at, we look at the markets and we see, great historical performance when we're looking at long-term averages. But if we look at, the day-to-day or month-to-month or even the year-to-year volatility, what we see is that investing in the markets can be very volatile, and it can provoke some real emotions. It can provoke fear. It can provoke greed. And so the way to mitigate or to help lower the volatility in your portfolio in investing is by asset allocation.
Yeah, it's really good. And why here, Shana, is it really important as a part of our strategy and necessary for the successful investor to be properly allocated?
Okay, so let's go back and let's talk about diversification, asset allocation, just a little bit. They're sort of synonymous. Diversification is a principle that says that different asset classes, so asset classes are things like stocks, bonds, real estate, commodities, cash. If you're in that camp, you can also include crypto assets in this different asset class breakdown. But diversification really is the principle of not putting all of your eggs in one basket. Like the scripture says, divide your portions. So this applies to different types of accounts as well. So, 401ks or IRAs, there's Roth accounts that you can invest in. These just have to do with how your investments are taxed, when and how much they are taxed. You could also have money in hard assets. For example, if you decide to cash in most or all of your investments to pay off your house, you're choosing to invest in real estate. You're choosing to invest in your house. So your investment strategy really helps to mitigate risk, lower the volatility, and produce higher returns, or more stable returns over time. Asset allocation is really just the way that is practically implemented.
Yeah, very good. And then just getting back to our strategy, why is it important for us? Why is this something that's good for us to do?
Well, proper diversification happens when you have a good mix of inversely correlated assets. Well, what does that mean? That just means that if you look at the relationship, the correlation between stocks and bonds, typically when stocks do well, bonds don't, and vice versa. So what you have happen is that not all of your portfolio is up at one time, and thank goodness not all of your portfolio is down at one time. So our economy really goes through business cycles. We have peaks, we have troughs, we have high peaks of growth, and then we start to decline. We have recessions, and then we have recovery, and the economy just cycles like this over about a 4 to 5 year time period on average. So during the slow times, there's certain things that will really shine and will sort of save your portfolio from going down a whole lot. Those are going to be defensive stocks, maybe utilities, staples, things that people are not going to stop buying if their income slows down, or if they get laid off or things like that. That's your toothpaste, your toilet paper. You're going to continue to pay your electric bill. During times of high growth, when the economy is really doing well, you're going to see other sectors of the economy really take off. You're going to see technology. That's what we've seen last year and this year really lead the way is technology. You're going to see small companies do well during times of high growth, whereas they don't do as well when the economy is a little bit struggling. So asset allocation is really the principle of how diversification is practically expressed. So if you look at our strategy, you'll get some real practical advice about how much you need to put in each different sector.
Yeah, it's really good, Shana. You mentioned the tech industry and kind of brought to mind, I'm sure there's a lot of people who are wishing that they were invested in tech right now, but we'll see it come down also. Kind of brings up a question quickly here before the end of the break. What are some of the dangers of being overweighted in one sector?
Well, there's two dangers, and they're at opposite ends of the spectrum. Yeah. There is dilution and there's concentration. So dilution is when you're just invested in everything. Most mutual funds and ETFs, in my opinion, are far too diluted. They have too many holdings, and they don't really take advantage of when certain companies or sectors really do well. On the flip side of that is concentration. You mentioned being overweighted. Well, the risk to that is that, it's going to be it's going to help your portfolio a lot in good times, but it's going to be a huge drag in down times. So I know we've got more thoughts on this. Maybe we can get to them when we come back. I hear the music. That means we're taking a break. Folks, our phone lines are open. 610-363-1110.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever He calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
And we're the Gen X.
And we're Samaritan members.
Navigating through investment options can be challenging, especially when you're determined to uphold your God-given values. Every dollar you invest is a vote for the world that you want to live in. Let your values guide your investment decisions and help to shape the culture in which we live. Become a beacon of light and pave the way with biblically responsible investing. Timothy Plan, where faith and finance collide. Before investing, carefully consider the fund's investment objectives, risks, charges, and expenses of the investment company. This and other important information can be found in the fund's prospectus. To obtain a copy, visit timothyplan.com or call 800-846-7526. Read each prospectus carefully before investing. Investing involves risk, including the potential loss of principal.
Folks, we're talking about this Friday morning, the idea of being well diversified in your investments. And Shana, you had mentioned a couple of phrases there, the ideas of dilution and concentration as we're talking about, being overweighted. Where would you say we lean towards in our ministry?
We lean more towards the concentration end. So, like I said, most mutual funds and ETFs have hundreds of holdings in them. So I think that's probably a bit too much for a really good portfolio. So, our strategy is more toward concentration. We recommend that you have between 30 to 40 individual holdings, and then there's a sprinkling of there's some funds and ETFs that are included to get to areas that we can't really get a lot of transparency on from a biblically responsible standpoint.
Yeah. And Shana, my last question for you here, really, I think I'm asking on behalf of our new listeners who might be wondering what you might suggest, tips and tricks that you have to help us maintain proper diversification.
That's a much longer conversation. Yeah. And we have lots of tips and tricks. Yeah. So, and I don't want to give away too much of our strategy over the air. We really want people to become partners of this ministry. We're heavily partner supported, and it's just $132 a year to become a partner. So once you become a partner, we do have specific targets for your asset allocation depending on how far you are from retirement. So that changes over time. So, to really have a good conversation about it, I'd have to, speak to the 20-year-old, I'd have to speak to the 80-year-old and everyone there in between. So depending on where you are and what your goals are for investing, your asset allocation models should look different as well. Well, at Financial Issues, we help you to stay in the know about the financial issues of the day. We help keep you abreast of what's happening in the markets, in the economies, and most importantly, we help you understand how that impacts your own personal financial issues. So, good bit of takeaways from this week, ending June 21st of 2024. This week, we got retail sales numbers came out on Tuesday. Retail sales in the U.S. edged up 0.1% month over month for May of 2024, following a downwardly revised 0.2% fall in April and below forecast of 0.2. This is another sign that consumer sentiment is cooling. If we dig down a little bit deeper into that number, core retail sales in May were a bit softer than what was expected. They rose 0.4% month over month, 1/10 less than what was expected, and off of a lower base because April was revised lowered as well. Year over year, retail sales are up 3.1%, which compares with the 5-year average leading into COVID of 3.6%, so lower than pre-COVID. Inflation is rising by a similar amount, so that can sort of explain why retail spending is up. If prices are higher, spending is up. So there is not any real consumer spending growth. This is not a good thing for a consumer-driven economy. About 70% of our economy is driven by consumer spending. So when we see retail spending start to slow down, that is a bit of a concern for the overall picture. We also got building permits out just yesterday. May housing starts came in almost 100,000 below expectations at 1.277 million, down from 1.352 million in April. Housing starts have consistently come in above the 1 million mark since last November, but for May, single-family housing starts fell under a million at 982,000. Multifamily construction starts continue to shrink as well. Multifamily construction starts totaled just 295,000 in May, and the second month in the past 3 months below 300,000. So this trend is not conducive to rents, which has been the stickiest part of inflation thus far. Less places to live means that landlords can charge more, keeping rents high. The population is increasing in the United States thanks mostly to our open border policy. So if we let anyone and everyone in, where's everyone going to live? We have a housing shortage in this country, and that lends to higher prices. Housing permits, which is also an indication of what is being built or what will be built in short order for both multifamily units and single-family homes, fell month over month too. So here's what the National Association of Home Builders said yesterday about single-family home builders. They said persistently high mortgage rates are keeping many prospective buyers on the sidelines. Home builders are also dealing with higher rates for construction and development loans, chronic labor shortage, and a dearth of buildable lots. Well, speaking of a dearth of buildable lots, if you're like me and don't have a very prolific vocabulary, I had to look up dearth. So it's a shortage, a scarcity of buildable lots. So that was interesting to me since we just added a new company in the consumer discretionary, CD20. If you want to check that out, that speaks to what we just saw the National Association of Home Builders talk about. Weekly unemployment numbers came out again, just as they do every week, and they are showing increasing signs of a crumbling labor market. Last week's 243,000 initial jobless claims was revised up by 1,000. So that means there were more jobless claims than what was originally thought. And it is proving to be more of a trend rather than a blip in the data. So last week's number was the highest number that we saw since last August. And the trend does continue to play out this week. 238,000 for the week ending June 15th. That was 3,000 more than what was predicted. The 4-week moving average, which smooths out that week-to-week volatility, rose 233,000 from 227,000, and that's the highest since last September. Continuing claims rose 15,000 week over week to 1.828 million, just 1,000 from the most that we saw in November of 2021. So there is a growing divide between what the monthly establishment survey tells us, the government numbers that tells us about the employment, the survey numbers, what they're asking people that happen versus reality. That's the number of claims that were actually being reported. We are seeing a pickup in firings. I think we've got a couple of charts to throw up on the screen there that just kind of helps us to back out and take a bird's eye view of what's happening. So this first one is continuing claims, I do believe, and it is 4-week initial claims. So notice that tick up that I have circled in red there. The upward trend in initial claims has been happening since March of this year. And then the second chart that we have, this shows a marked increase in continuing claims. So we see at the end of 2022, we see kind of how they kind of jumped up there. For most of 2023, they kind of rocked along. But then if you look there at the end, you see that the very end there, you see that it looks like these claims want to take off again. So how's this translating into market activity? Well, markets were closed on Wednesday this week in observance of Juneteenth, so we did have a bit of a shortened week. On Thursday, the indices closed in mixed territory. The S&P briefly topped the 5,500 mark for the first time ever before shrinking back into negative territory for its close on Thursday. But by the closing bell on Thursday, all three stock indices were on track to close in positive territory for the week. So the Dow is up 1.5% for the last week. The S&P is up 0.78, and the Nasdaq's barely hanging into positive territory at a 0.09% increase. The pre-markets this morning have sort of been all over the place, but kind of hovering around the flat line, which they're still at. So what's coming up next week? Well, we have the final look at first quarter GDP. Now, GDP measures growth of the economy. So we get a first look, a second look, and a final look as the numbers come in and are really analyzed. The first look at GDP was a 1.6% growth rate. The second look was revised down to 1.3, and we're going to get that third and final look at GDP for the first quarter of 2024, which we're about to close out the second quarter. So this is a little bit of a dated number. So it's expected to come in at 1.3 as well. This is noticeably slower than the 3.4% growth rate that we were experiencing the fourth quarter of 2023. We also get an inflation read next week. PCE number comes out. That's the Fed's preferred gauge of inflation. It is expected to be down 0.1%, supporting the narrative that we are seeing disinflation. Not prices go down, but we're seeing that the rate of inflation slow. Personal spending and personal income are also going to be reported next week, and they are both expected to be slightly up as well. Now that you're in the know about recent and upcoming financial issues, we want you to learn more about how we can help you integrate those issues into your own stewardship. Find out more about how we can help you defund darkness with our biblically responsible portfolio strategy, putting Christ at the center of your investment decisions and helping you to be an obedient, joyful, and generous giver and fund the light. So when you're a partner, you'll get access to weekly commentary. We write things in the partner section of our website that our partners only can access, and we have conference calls once a month to discuss what's happening more in depth. And the most recent partner conference call is posted on the website. If you're a partner, you can log in and see that. Well, folks, if you're listening or watching on an outlet that only carries the short version of the show, we have to bid you a farewell and a happy weekend. We hope that you have a wonderful day of worship on Sunday, but we do have a longer version of the show. That can be found by downloading our phone app. That's the best way to get it. Whether you're Apple or Android, just go to your app store. You can catch the current day's show over and over and over till the next new one comes out, and you can also get the archived versions of the show. For the rest of you, stick around. We're going to be back with more financial issues right after this break. Through the ministry of Preborn, the Financial Issues family has saved tens of thousands of lives of babies. What an amazing job that God has done through you, the Financial Issues family. Would you join us in saving the lives of babies? What an amazing reunion we will have in glory, meeting all the people that we have saved. Please go to preborn.org, that is preborn.org, or financialissues.org, and click on the Preborn banner.
Here at FISM News, our mission is to provide you with news from a source you can trust.
The news is a constant reminder that this world is not our home. It is marred by sin, resulting in wars, brokenness, and divisiveness.
Jesus promised that he will return soon to judge sin and make all things new.
Until then, we place our hope in him.
This is the good news, the most important truth we feel compelled to share.
I'm John.
I'm Debbie, and we're Samaritan members.
We have 8 children, ages from 30 down to 15, and we have a ministry called Family Man Ministries.
When he left the pastorate to start the ministry, we had no income for about a year potentially, and so we were living on almost nothing. The cost of health care seemed impossible because we had a big family. And so when I started researching ministries, there was no comparison. It was just the best deal. And so a year after we joined, my 10-year-old daughter at the time got pneumonia, and it was scary. Someone sent a card just to Maggie, and it said, not just that we're praying for you, but that God will always take care of you, and here's $5 for you to go out and get ice cream. It was just really special.
To make that connection, that's an amazing thing. I was sold on Samaritan Ministries. I just thought, okay, I'm a part of this.
If you don't get life right, you're not going to get all the other issues correct, period. It is the issue that impacts every other issue. Life is the central part of what keeps this republic together. It is the contract that the founding fathers passed down through multiple generations. Life, liberty, and the pursuit of happiness. You don't have life, you don't have a republic. There is a temptation out there right now. And I want to just tell you we must resist it. There's this temptation that we cast this issue aside. How does that honor God? It doesn't. And if it wasn't for Preborn, I would be super just confused and depressed, because there has never been, in my opinion, a more disjointed time in the pro-life movement. We need a machine to go up against the Planned Parenthood beast. Like, we have to play offense against the pro-abortion forces in this country, okay? We have to play offense. And Preborn does it in this compassionate, merciful, godly way that is just so inspiring and amazing.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only, and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it, and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. Today's Rapid Fire Friday, so that means we want to get to as many of your questions and calls as possible. If you get your call queued up now, 610-363-1110, you will be our first caller in the queue, and we'll be sure to get to you today. So again, 610-363-1110. Go ahead and give us a call. Don't be shy. If you have a question, odds are many other people out there listening do as well. So you'll be helping them.
Yeah, amen. That's good, Shana. Yeah, let's get started here with Ron on Ask Shana. He says, I use the 75 to retirement model with a dash of the income model. Nice. Is there a place in my fixed income sector for either FI56 or FI36? If not, should I sell them off from my portfolio? We had another similar question about this, Shana, from Michael later on down the line there. But perhaps we can tackle Ron's first.
Okay, so Ron's question, well, those two that you mentioned have had sell alerts issued for them. And we did talk about that a little bit in the conference call. So if you missed that, maybe go back and listen to the partner conference call. It is posted. The restructuring that we're doing of the fixed income category does call for a sell for those two.
Awesome. And speaking of that sell, Shana, that was really the timbre of Michael's question also. He's asking regarding the recent suggestion to sell those two positions. I'm currently down in what are substantial combined positions, about 12% of my portfolio in these two accounts. Their historical price appears to have ranged approximately 10 to 20% higher for a number of previous years. Does this mean you do not expect them to trade at those historical levels for years to come? And what might cause them to rise to those levels? And Michael's 69.
Great question. Yeah. So what caused them to go down a good bit was the Fed's rate increase cycle. So in 2022, we saw the Fed increase rates, I think about over 11 months, increased them from virtually 0 to 5 to 5.25, which is what we have now. So bond prices, which is what these two funds are made up of. They're made up of bonds. So bond prices and interest rates have an inverse relationship. That means when interest rates rise, bond prices drop. So that's the phenomenon that you saw here. So theoretically, when we get into a cutting cycle, when interest rates start to go down, bond prices should rise. So that might be the stimulus that makes them go back up. But, I really think that the fixed income portion of your portfolio, because we did talk about asset allocation earlier in the show, and I think that the fixed income portion of your portfolio is really in some stability to your portfolio. So I'm more in favor of just using fixed income investments that won't really have a whole lot of fixed income, of volatility, because the volatility, you're going to have plenty of volatility in your portfolio from the stock portion.
Awesome, Shana. Matt,
did I get all his questions?
I think so. Yeah. Yep. No, okay. I think so. Yeah, that was great. Michael and Ron, thank you for those questions. Matt's up next here, Shana. He's reading about UT35 being bought out by a non-publicly traded company later this year and going back to private. So his question is, what will happen with my current investment in the company? Will they simply buy me out at $22 a share? If so, fine, I'll have that to reinvest in another utility and just wait and get a few dividends, or will it be something more complicated? That's actually a really good question, Shana. I'll bet more people are wondering that, what happens to their funds when a stock goes private.
Well, it all depends on the deal, the details of the deal, and I think Matt's right on track there. That if the deal does go through and close as it says, you'll end up with $22 a share, and then you'll just have the money to reinvest into something else. So, these things happen all the time. We've had several. I can think of one in the healthcare sector that happened here recently, where a private company bought them out. Investors were left with cash instead of their shares, and then you have to find somewhere else to redeploy that cash.
Yep, good stuff. Shana, speaking of which, I failed to mention this to you on or off the air, but Darlene's out today, so we got Elijah on the phone. So if people call in, they get to talk to Elijah, which is always a treat.
Yes.
Good stuff. We might be getting a call coming in right now. But before we get to that, let's get to Val, a new partner, new investor, looking for growth. Open to Fidelity Roth IRA. I contribute weekly to it, to ETFs 1, 2, and 4, and some other funds as well. I'm not fond of the stocks or mutual funds. Majority buy list stocks from the ETFs, so it makes sense to stick with the ETFs. Should I sell ETF 2 and another one that Val mentions and redistribute that into ETFs 1 and 4 as well as another stock due to loss and overlap, or ETF 3? What do you think, Shana? Val's 50.
Yeah. So the two that he mentions, I would just encourage you to go to the screener and screen them. One is actually coming up dirty, which may or may not be. I kind of question that. But the other is it doesn't show up on the screening tool either, and they're both products of another screening tool that we use as well. So you're right. There's a good bit of similarity there. If you're going to follow the fund ETF strategy, there's a reason that some of the mutual funds are in there too. You're going to get some exposure to things that you can't get in the ETFs that are on the list. So, I can't really deviate from what we've said is best for the partners, and that's reflected in the asset allocation models.
Awesome, Shana. I think we got time for a call here. John from Alabama is calling with a good question here, if that's all right. John, good morning. You're live on Financial Issues.
Yes, sir. Shana, my question is, why, if the economy is so good, why then are we going to have to pay off student loans or student debts?
That's a good question.
That's a
I'll
great.
listen to you offline. Thank you.
That's a great question. So if the economy is so good, and we've recently had the Biden administration come out and, use election year math to tell us how great the economy is and how much Bidenomics is working. So why do we have to pay off student loans? I mean, if the economy is so great, can't these students just get into the economy, get good jobs, and pay off the debt that they agreed to pay themselves? Well, yes, they could, and yes, they should. So the reason that he's doing this is to get votes. I mean, his approval rating is as in the tank, very, very badly. I mean, the polls, President Trump is polling so much higher than President Biden former President Trump, I guess I should say, is polling so much higher than Biden in so many things, and it's all about the economy. Just like I think it was Clinton that said it's all about the economy, stupid. Well, he needs to tell his Democrat friend that it's all about the economy, stupid. And so I guess Biden gets that a little bit, and so he's trying to make the personal economy for some much better by paying off their student loans while burdening the rest of us with that.
Yeah. And Shana, I think it's all related, all the stuff we talk about, because we see an administration that is not only willing, but I think overly eager to spend taxpayer dollars on anything and everything. And like you said, it makes perfect sense. They're willing to spend, they want to spend it, and trying to curry votes. This is the way to do it here. Absolutely.
That reminds me of speaking of politics, of a headline that we saw recently that's in there, with, I thought we had more time, but we've got the ag report coming up, don't we?
We might have to hold off on this headline. Yeah, folks, going to have to stay tuned. Shanna, we might be able to get to a quick question here before the ag report.
All right, let's do it.
I think we have time for it. Keith was listening to Wednesday's show of this week, and he was saying on the show, Shanna was talking about savings. Would a bank money market be considered savings or investment?
Mostly savings. That's where you're going to put money, like in the money market. You don't want any volatility with that. But there's also a place for money market in your investment portfolio. If you look at the asset allocation models that we have, there's allocations for cash in all of those. So primarily, it's what you normally think of as savings, but there is a place for it in your investment account. Well, folks, we're going to hear from Craig Haugaard. He has our ag report for today, and then we're going to continue on with Rapid Fire Friday after a short break. So get your call queued up, and here comes Craig.
This is Craig Haugaard with your Financial Issues Ag Update for June 21st. Corn prices collapsed yesterday as the extended weather models showed an end to the dry pattern that has plagued portions of the Corn Belt in recent days. At the closing bell, July corn was 10 1/4 cents lower as it'll settle at $4.39 3/4 per bushel. Soybeans also fell in the face of the improving forecast as we saw new crop soybean futures slide to their lowest level since November of 2021. At the close, July beans were 18 3/4 cents lower, ending the session at $11.55 1/4 per bushel. Wheat is in a downtrend, and so far there's nothing to make it come out of its tailspin downward. Yesterday's news that a private analyst was increasing the size of the Russian crop brought in another round of selling. At the closing bell, Minneapolis July wheat was 14 cents lower at $6.18 3/4. Kansas City dropped by 8 3/4 cents to close at $5.92, and Chicago was 9 1/4 cents lower at $5.72 3/4. Cotton futures just seem to want to keep drifting lower. Once again, we were down with July futures closing 18 points lower yesterday, settling at 70.85. Livestock futures had a mixed performance. We had August live cattle futures 45 cents higher at $182.55 per hundredweight. August feeder cattle dropped by 12.5 cents, so they settled at $259.82.5 per hundred. And August lean hog futures had a fairly rough session. They were down $2.45 for the day, closing out today at $89.12.5 per hundredweight. Class 3 milk futures tested the support level at $19.50 and then bounced higher off of that level. At the close, July futures were up 16 points as we settled out today at $19.77. Well, this has been Craig Haugaard with your Financial Issues Ag Update. We'll be right back with more financial issues after this.
anybody's listening thinking about joining, there's nothing like it. It's been great. I have peace of mind. I feel confident continuing to work. There's just a lot of things that y'all have added to my financial peace.
You guys are the man. So I encourage everybody, partner, get in there and watch the videos. Portfolio after portfolio, you hear the stories. It works. And you guys make it possible. And I thank you for that.
Married couples or even engaged, as you're coming together, working on your finances, God has blessed us incredibly. And it's been incredible to see what he's done in our lives. Just want to thank you, Financial Issues.
As a novice investor, which I am, and I'm certainly learning so much from y'all. Thank you so much. Y'all take the fear out of it. And my portfolio is doing great.
You've really encouraged us, and I know you've probably encouraged so many others as well.
Become a partner today by simply going to financialissues.org/join. Click the green button to become a partner. That's financialissues.org/join.
There are moments in life that define us. Choices determine the courses we take. Choices that create life, or those that save a life. And some make life worthwhile. There are decisions to stay or to go, to remain the same or to grow. Sometimes we pray and make peace. Other times we take a stand for what we believe. In celebration, mourning, triumph, and defeat, we are invested in every decision we seek. Despite differences, we have one thing in common, the desire to do all for the glory of God. Keep your wallet aligned with your heart and your investments in harmony with your faith. Timothy Plan, biblically responsible mutual funds, ETFs, and retirement plans. Before investing, carefully consider a fund's investment objective, risks, charges, and expenses contained in the prospectus available at timothyplan.com. Read carefully before investing.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues, folks. Hey, if you were listening to the last segment there, John from Alabama's call sparked some interesting commentary from Shana and myself. Shana, there was a headline that we wanted to get to there. We ran out of time because of the ag report, but the headline is this: politics increasingly are driving consumers' buying decisions, according to a recent study. Is that a surprise? I don't think so. A whopping 60% of 15,000 respondents worldwide said they make purchase decisions based on whether brands share their political views. More than 1 in 3 consumers polled said they're boycotting brands that support a side in the conflict in the Middle East right now is a big one. There was one particular person told Fox Business that 80% of respondents said they're boycotting brands from specific countries. So, Shana, this seems to relate to biblically responsible investing, at least a little bit on the surface. What wisdom could you share with us in light of this study?
Well, I think it's absolutely crazy that we have to go shopping and then wonder if what we're going to buy is going to make a political statement or not. But, I mean, I do believe that it's happening. That's why, you know, companies like Public Square exist. You know, Public Square is centered around the freedom economy, you know, so companies who didn't make their customers wear face masks or, you know, that support more conservative traditional values have come together to come against like the Amazons of the world. And so, you know, I do believe that it's happening. And just a kind of a personal example for me, I think it's just really frustrating to have to think twice about what kind of social or political statement I might be unknowingly making by wearing a certain brand. So when I went to I got to visit West Palm Beach for a True Social event, and part of that was we got a dinner at Mar-a-Lago, and so I don't go to a lot of after 5 things, so I had to go get me some clothes, and I was looking at some shoes, and I saw these shoes that I liked, and they had this eagle emblem on it, and I thought, oh wow, cool, America, you know, that's right. Let me get this, but you know, something in my gut just said, you know, that may not be exactly what you think it is. So I just kind of passed over them and looked for something that was really just kind of neutral and didn't make a statement either way. Well, come to find out, I did some research after the fact and found out that the emblem or the brand was Kurt Geiger. I guess that's how you say it. I don't know. I'm not a big fashionista, I guess. But and that they're very liberal. In fact, they say that their rainbow is their signature, and it represents good energy and the love we have for our communities and the many ways that we collectively express our individual style. And that, you know, they're all in on the Pride Month, and they're even making donations to help the LGBTQ agenda get pushed forward. And, you know, when I looked into it a little bit more, Kurt Geiger is a UK company that's founded by a straight Austrian Jew that was a refugee of Nazi Germany. Now it's a woke apparel company supporting LGBTQ equity, inclusion, and other nonsense with its profits. So, I mean, that just, I wonder what Kurt Geiger would actually think about the company.
Absolutely, yeah.
I wonder if they support Palestine, too.
Yeah.
That would be just a travesty.
Seriously.
Well, thank goodness I listened to my gut and didn't buy those shoes and wear them to Mar-a-Lago.
Good move, Shana. That was good. Absolutely.
You know, rather than being politically motivated, though, we should be values-oriented. And our identity, although many of us are so proud to be an American, our first identity should be as a citizen of heaven and as a Christian. And we should adhere to those values, and especially when we invest, don't support those companies that are supporting the values that we're praying against every day. The abortion, the pornography, the LGBTQ, everything that's destroying the moral fabric of our country. So help keep money out of the kingdom of darkness.
Well said, Shana. That's
we got
good.
a call.
We do have a call. Don from Kentucky's calling. Hey, Don, you're live on Financial Issues with Shana.
Hello, guys. How you doing today?
Doing good.
Doing great, brother. What's on your mind?
Well, I'm about 68 and a half years old, and I think I told Elijah calling in I was a couple of years away from the RMDs, but I may be more than that. I forget what they've actually age. I've got to start making an RMD.
Probably 73.
Okay, so I'm a little further away, but that's good. That way I haven't procrastinated as bad as I figured I had. I basically am drawing from my rollover IRA, supplementing my retirement income, supplementing my Social Security, my wife and I. I think my RMD would just estimate would probably have to double that amount. Don't need those extra funds, but what should I be doing now, preparing for the time when the RMDs do come into play? What advice can you give me, Shana?
Well, if you want to try to get your RMD lower, your RMD is calculated on the value of your IRA account on December 31st of the prior year and your life expectancy. So one of the things that you could do is to work towards getting the balance reduced. So one thing is that the age for qualified charitable distributions hasn't changed. It's still 70 and a half. So if you're coming up on that, once you're 70 and a half, I mean, you want to, really look at your tax situation, but I would consider very much doing all of your giving with your IRA once you turn 70 and a half, because that's a way that you can reduce the balance without paying taxes on it. So it's essentially like a tax-free withdrawal. So continue to take your income, but once you get to that age, switch over and do your giving. That's going to help reduce the balance of your IRA. Another thing that you could consider is we're sort of in a window that may be closing in short order. So the tax cuts that Donald Trump implemented during his presidency began for the tax year 2018. They do expire next year. So we've got this year and next year where we have some relative certainty about what tax rates are going to be. And I am in the camp, I firmly believe that taxes are going to be higher in the future than what they are today, simply because we continue to spend way more than we bring in. And so President Biden has already said that if he's elected, he's not going to renew those. I think, we're going to spend some considerable time talking about this in the shows coming up, but one of the things that you can specifically do right now is use this window to reduce the amount of money in your IRA account so that your future RMDs are lower. So especially if you're in the 12% tax bracket, I would do some calculations, maybe talk to your tax preparer, see how much room you have left in the 12% tax bracket. So that extends, if you're married filing jointly, that extends roughly up to about $90,000. And so if your taxable income, is say around $60,000 right now, well, you could get another $30,000 this year out. Even though you don't need to spend it, you could just pay the taxes on it and move it to an investment account. That way, you're paying the taxes at a lower rate than what they're possibly going to be in the future. So you could really take this year and next year and look at that strategy. That would help to reduce the balance, not necessarily reduce the balance of your investment portfolio, because you would just be moving it to a different kind of account if you're not spending it. And that would help to, lower those RMDs in the future. But, even if you get to that magical RMD age and, your RMD is significantly more than what you're taking out, if it's even more than what you're spending plus giving is, then, you'll really be forced to implement that strategy where you're moving money out of your IRA into an investment account. Just hopefully it won't be at a higher tax rate.
Well, I think if we our fears that Biden get reelected, do everything I can to prevent that. But if our fears come true, well, he's going to take care of it for us, so it doesn't really matter, does it?
It doesn't. That's one of the risks. We talked earlier in the show about diversification and diversification amongst accounts. And, I think the financial community did a really great job of convincing people to take advantage of 401ks and pre-tax money, because we get so short-sighted and focused on this year. Oh, tax time is coming up. What can I do to avoid paying taxes? Well, you can't really. There's not many ways that you can really avoid paying taxes and stay out of jail. But we have all been.
Hunter Biden.
You took the words out of my mouth, John. I didn't want to say it, but I'm glad you did.
Even if you're Hunter Biden, right? But there's things that we can do. I think a lot of us bought into that, and I work with a lot of retirees, and so many of their liquid assets are concentrated in these pre-tax accounts. So yes, they got out of paying taxes in that current year, which probably worked out good for them because they were in a much higher tax bracket when they were working under a different tax structure than they are now, then they're getting it out. So that worked out great, but I think that trend is reversing, and I think we really have to put some effort towards getting those tax postponed investments
Well, I am trying to gradually just kind of err in the way of higher cash position in case the market does go way down significantly, and as some of the things we said could happen. So I'll be listening. I just want to make sure I wasn't missing some things that I should be doing. Sounds like most of it I'm in that moving in that direction. So appreciate your guidance.
Thanks, Don.
Well
Thanks
done,
for calling.
Don.
Sure, you helped a lot of people today.
Yes, sir.
Well, folks, that's a wrap for Rapid Fire Friday. We are coming up on the weekend, so we hope that you gather together with believers and have a wonderful day of worship on Sunday. And tune back in next week for more financial issues, because Lord willing, we're going to be here to remind you time is getting short. The Master is coming back. There's going to be a test, and we want to help you be found a good and faithful steward. Come back next week for more financial issues, and check us out at financialissues.org.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.